In June 2026, SpaceX filed to go public at $135 a share. That immediately prices the company at a $1.75 trillion valuation. A massive portion of that valuation relies on Starlink. It is a highly profitable cash engine, currently generating $4.4 billion in operating income at a 63% margin. But those profits are immediately consumed. SpaceX uses that cash to subsidize massive R&D for Starship and a $12.7 billion infrastructure build-out for their XAI segment. When you net those expenses against Starlink's income, that $1.75 trillion market cap translates to an enterprise value trading at a staggering 270 times trailing EBITDA. For anyone buying at the offering price, the math creates a rigid constraint. You are paying for a level of flawless future execution that leaves almost zero room for error. Quantitative analysts ran a 100,000-path Monte Carlo simulation to project how this specific stock might perform in the aftermarket. At the 5-year mark, the median projection is a 70% drawdown. The typical modeled path drops the share price to roughly $30. Expand that out to a 20-year horizon, and the base case model yields roughly zero price appreciation from that $135 entry point. Those catastrophic price models do not assume the company fails. They actually assume SpaceX executes its business plan perfectly and grows its top-line revenue by 11 times. This projected price collapse has nothing to do with bearish sentiment on the technology. It is simply the inescapable consequence of equity mathematics and multiple compression. Let's look at this baseline equation for pricing the stock. Required enterprise value equals your target share price multiplied by the total outstanding shares. If you want the stock to stay flat at $135 over the next 5 years, and we factor in a standard 2.5% baseline dilution, SpaceX will have about 15 billion shares. That requires an enterprise value of $2.02 trillion. But companies cannot sustain a 270 times valuation multiple as they scale. As growth matures, the market naturally compresses that ratio down toward a historically standard 28 times. To justify a $2.02 trillion valuation at that newly compressed 28x multiple, the company must generate $72 billion in EBITDA. Assuming an optimistic base case profit margin of 25%, producing that much earnings requires $288 billion in total top-line revenue. Going from today's revenue to $288 billion in exactly 5 years demands an annualized compound growth rate of 73%. Just to tread water and keep the share price exactly where it started, SpaceX must sustain a 5-year compound growth rate that has never been achieved in industrial history. This chart compares that required target against real historical precedents. Amazon's absolute fastest 5-year growth period during its rapid early expansion maxed out at a 35% annual rate. During the peak of its transition to mobile advertising, Meta managed to hit 50%. Achieving 50% growth on a small base is difficult. Achieving it on a multi-billion-dollar base is exponentially harder due to the law of large numbers. The mechanical re-rating from a 270 times multiple to a 28 times multiple creates a mathematical headwind so massive that even flawless historical hypergrowth cannot outpace it. Looking at the 1 to 3 year horizon, we have to shift from pure algebra to stochastic modeling. This simulation charts 100,000 possible price paths. Because the company has zero public trading history, analysts rely on a proxy basket of similar space and tech equities. That establishes a massive 45% conditional volatility rate. High variance equities are heavily impacted by a mathematical phenomenon known as log-normal volatility drag. As the simulation runs, the drag formula, -1/2 sigma squared, actively pulls the dense typical median trajectory downward, eventually settling near $30. Yet if you calculate the simple mean average of all 100,000 paths, it stays artificially elevated near the original $135 mark. That happens because of the fat right tail. A very small percentage of extreme low-probability binary events, like Starship successfully driving orbital costs down to $10 a kilogram, shoot exponentially upward, skewing the overall average. In high-variance growth stocks, the mean average hides a harsh reality. The massive upside of a few outlier paths masks the fact that the typical median investor loses money. Over the 10 to 20-year horizon, a different structural constraint takes over: dilution. Cumulative stock-based compensation creates a baseline drag, expanding the total share pool steadily over decades. The public filings outline massive performance-based equity tranches. These benefit executives by issuing new stock when specific valuation metrics are met, coming directly at the expense of the public float. The ultimate payout is a specific 1 billion share tranche tied directly to achieving a permanent Mars colonization milestone. If the company hits these historic milestones, the newly minted shares mechanically dilute the public Class A shareholder. The total value of the company is suddenly sliced into vastly more pieces. Even if SpaceX succeeds wildly and hits a $7.5 trillion market cap, the growth in overall enterprise value won't equate to returns for the individual shareholder. This graph maps the collision of these forces. A red curve descends as the multiple compresses over 20 years. A green curve rises as revenue compounds to $282 billion. They intersect at the crossover point, where revenue growth finally overcomes the massive multiple contraction. Because these two massive opposing forces perfectly offset each other, the base case scenario leaves the actual stock price essentially flat over 2 full decades. We saw this exact structural paradigm with Cisco at its valuation peak in the year 2000. The underlying business compounded successfully for 20 years, but the shares went nowhere. A highly successful company can still be a highly demanding stock. In this scenario, fundamental excellence merely prevents a total price collapse. Generating actual positive returns over a 20-year horizon requires navigating an incredibly narrow path. To break that multiple compression curve, SpaceX must establish a self-sustaining multiplanetary economy and maintain an absolute monopoly on orbital AI compute infrastructure. That brings us back to the reality of the $135 entry price and the $1.75 trillion valuation. Investors stepping in at this level are fully prepaying for a solid decade of flawless hypergrowth. True yield on this asset is exclusively isolated in civilizational scale success. It is a generational bet where perfection is the baseline expectation just to break even.